Hi everybody. Today we're going to talk about the share guide page on your newspaper. It applies not just to newspapers but also to, nowadays we have these quote pages, Yahoo Finance, Google Finance, Amazon, there's also like Bloomberg, etc. So you have a number of basically general finance pages where they talk about shares. And we're going to cover some of the aspects or some of the jargon used in these pages to make these a bit clearer to the average investor. Now, why do you basically want to look at these pages? Because they give you information about share price moves, as well as the history of that share. But remember, this is not a real valuation. You aren't looking at a proper valuation about the actual value of a particular share or security. You're looking at just the share price movements as well as some indicators as to how it's performed in history, as maybe some basically gleaning of valuation. But to do a proper valuation, you probably have to do the things we talked about in our last webinar on valuing shares. Okay, the first thing we're going to cover is the symbol or ticker. In South Africa on the JSE, we have a unique three-letter symbol. For instance, SOL is Sasol, EXX is Exaro, KIO is Kumba. These symbols basically are identifying letters or symbols for every particular share. Internationally, we have symbols used as well, but they vary in length. For instance, Citigroup has just a C. Facebook has FB, 2 letters. And Alibaba, which was recently listed, has BABA, B-A-B-A, 4 letters. What generally tends to happen is that you'll find that these particular symbols are used across a number of platforms. So for instance, if you have access to Bloomberg or Reuters or basically your trading program, typing in SOL or EXX will bring up Sasol or Exaro. Similarly, if you're international, you type in C, you'll get Citigroup, or FB, you'll get Facebook. These symbols are constant, and if they do change, there has to be an announcement surrounding that as well. Next, we have the high and low for the day. This is self-explanatory. It's the price range for the day, the highest and lowest price of a particular share. But what's important about this particular indicator is it gives you an idea as to the volatility of the share. Volatility is basically how much it moves about. How much change can you expect from the particular stock? A large percentage range, for instance, if you see a share that's worth 100 rands going up and down 10 rands in the day, it generally corresponds to a higher level of volatility. A 100 rand share that goes up maybe 50 or 60 cents a day, you'd think that's a lower level of volatility. Now, just one thing to be aware of here is that this applies generally to larger shares. For some smaller shares, you'll find that often there is maybe just a single trade or maybe no trade even for a particular day. In some cases, you'll find just one price traded the entire day long. It does not mean that this is a low volatility share. It just means it's a low liquidity. It has it has very little trade occurring on that particular share. When you use basically the trade or the price range of the day to determine volatility, it's generally better used for larger, more well-traded shares. Now, there's a term called fat fingers. Imagine if you have a very fat finger and you press a button on the keyboard. Sometimes your finger is so fat you might press another button next to it. And this is a term that traders use to basically describe an event where somebody makes the wrong trade. I personally, a while back when I was very young, made a trade on Kumba. I wanted to sell Kumba shares, 500 Kumba shares for about 250 rands. Instead, I sold 25,000 shares for 5 rands. Luckily, it was Kumba. It was a very well-traded share, and I only managed to move the market down about 2 or 3 rands. But still, I did it for 25,000 shares. So we're talking about a loss of 700,000 rands. This is a fat finger. Be aware that this can occur. So sometimes when you see a really low or really high price for the day, it could be due to a mistrade that might have occurred. Now the high and low for the day is often represented in a candle chart. We've heard the term candle charts, wicks and shadows. Here's an explanation of just what's happening in that particular chart. This here is a candlestick. The green one would be an upward move. The red one is a downward move. The body of the candlestick, the part that's green, would be the distance between the open and close price for the day. So the bottom towards part of the green would be the open, the upper part would be the close. But the high and lows are different from the open and close for the day. So you could find a share that has a very small gap between the open and close, maybe 1 rand or so, but a huge gap between the high and low, maybe it's in the region of $10, showing a high level of volatility, but even though the share in the day may not have done much in terms of an actual price move. Sometimes you can have no actual price change in the day because the opening price will be the same as the closing price. But in the day, the share may have moved quite dramatically. And for the chartists out there, you know that you can find quite a lot of information out there that attempts to draw some information about future price movements determined by the shape of these particular candle graphs. Okay, the 52-week high and low. 52 weeks, as you know, is a year. This is basically the highest price and the lowest price over the last year. This is quite a common indicator, a common thing that you find in most of these share quote sheets, and it's important because what it gives you is an idea as to just what the shares range has been for the last year. But often when you find that if your current price is quite close to the high or the low for that share, it's a significant event. It might be something that could form resistance or support for the particular share. So if a share is really low at the 52-week low, it could provide some kind of support because some people might believe it's fallen enough, etc., etc. Likewise, if it's a 52-week high, again, you'd find that some people believing that it's probably going to form resistance there or have some resistance trying to break through that particular level. Another important indicator given to you on that share sheet would be volume. Now, for technical traders out there, you've heard the term that without volume, without actual number of shares being traded, you don't actually know how important or significant a particular move is. Volume describes basically how many shares were traded on that particular day. So for Kumba, it might be multiple millions. For some of the smaller shares out there, it could be a few tens of thousands, a few thousands in some cases. Now, what volume gives you is a measure of liquidity. Now, liquidity, you've heard this term before, I'm liquid, I mean liquid, blah, blah, blah. In terms of the stock market, liquidity means the following. Liquidity is how easy it is for you to enter or exit a trade. What do I mean by that? Let's just say there's a share out there that you want to buy into. You want to buy 1 million rounds of that share. If not much or not many shares trade in a particular day, maybe just 100,000 on average trade. If you go in with your 1 million rounds, you're going to be basically buying 10 times more than the average traded volume for that day. It's like going to basically the lady selling guavas on the side of the street and trying to buy all of guavas in one bundle. In all likelihood, you're going to change the price of those guavas. If, however, you have a much larger share, much more liquid share, imagine a share like SAB or MTN that trades hundreds of millions of rounds a day. Your 1 million rounds is basically less than 1% of the total volume traded in a day. And therefore, you could easily go and buy, quite a large quantity of that particular share without having an ability or without having an impact on the price of that share. The general rule is highly liquid shares have higher trading volumes. I would suggest for people that are looking to trade or even to invest, liquidity is an important measure to take into account because sometimes you might find yourself in a position where you have a share and you want to get out of it, but you may have made a huge profit and the share has gone up and up in price. But when you want to get out of it, you're getting out in such a way that the actual act of you selling that particular share drives that price down significantly, and you aren't able to take all your profits out. Try and stick with shares that have quite significant liquidity, and don't go for shares unless you're a very wealthy individual in which you are the largest trade for the particular day. It generally indicates a low level of liquidity compared to what you want to do with that share. Another important indicator, another important number given to you on shares is the dividend yield. It's simply the dividends that you get per share divided by the share price times 100. Often you'll find that some shares don't give a dividend, therefore there'll be no dividend yield. And usually the indicator here is the higher the better. You want a large dividend coming out. It's like basically the earnings that the company makes that they give on to you. So in some cases, especially if you're looking towards retirement, getting income, you want a higher dividend yield. Higher dividend yield stocks are very good. In fact, just choosing high dividend yields as one of the criteria for your investments tends to put you towards better quality, more stable stocks, lower risk stocks. Reason is quite simple. If a company can pay a dividend, it generally is a higher quality company compared to companies that may not be able to pay a dividend. There are obviously exceptions. The most notable exception until quite recently was Apple. While Steve Jobs was alive, he was never willing to actually pay a dividend, believing that he could always do better or do more good with that money than the average investor could. Since he's passed away, we've seen more and more pressure on the company to pay out dividends. So it's an indicator, like I mentioned, of health of a company, but just because there's no dividends does not mean that you would look towards a company without dividends as being, by definition, a bad company. It's just that generally you'll find companies that pay more dividends are better than companies that pay less dividends, with exceptions. Another term to learn about is special dividends. Sometimes a company will do something big. For instance, when Telkom got rid of Vodacom, its Vodacom shares, what happened was it was bought out by Vodafone. So it got a huge profit from that particular transaction and paid a special dividend to the shareholders. Why? Because the transaction was so large that the company was suddenly left with a huge amount of money. It did not know exactly what to do with all that money, so it decided some of the money, if you can't do anything with the money, it should return it to shareholders, and it was done by a special dividend. Generally, a company should always have an investment goal for its money. It shouldn't just be stocking up money for the hell of it. If the money is not being used for anything or doesn't have a future purpose, it generally is best for the company to return those monies to the shareholders. Something we covered before, we've talked about that a number of times, is the PE ratio. The PE ratio basically is the price of a share divided by the earnings per share. And again, generally, there's a rule of thumb here. Lower is better. Why? If the price of the share is quite low compared to the earnings you get from it, that means you're probably getting a share that is reasonably good value. If the price of a share is much, much higher than the earnings you get from a share, there's often a much greater risk involved in that particular share. There's much greater uncertainty about the valuation of that particular share. Now, just looking at some examples, in our environment, if you look at a share that has a very high P ratio, it could be something like Curo. Curo is the company that does private schooling. Right now, that P ratio is quite high. Why is that? It's because Curo is in a high growth phase. If you have a very high growth rate, you can justify a high P ratio. Why? Because you say, yes, earnings right now are not that great, but earnings in the future will be much higher. And so we can't just pay for the earnings right now. You have to pay for the entire earnings, current and future earnings of a share when you buy a share. And the future earnings will be very high, and the price should be very high. But you have to have this good growth rate to justify basically a higher P ratio. One of the largest companies in this country is Naspers, which is a P ratio of close to 60. The reason for that is because it holds a huge stake in a company called Tencent in China that has a very high P ratio. A good rule of thumb for P ratios is basically low teens, 10 to 15. Above 15, you're probably getting into the high value. Below 10, you've got to be worried exactly why does this company have such a high P ratio. Maybe earnings right now are very high, but maybe there's something in the stock price or something in the stock that makes you believe earnings in the future will be much lower. If, for instance, you see a company out there with a 2 or 3 P ratio, it means right now earnings are very good, but you expect them to fall dramatically in the future. Otherwise, the market would be flocking to this company because it gives such a huge return on your investment. Generally, I would advise people, unless you have a really good reasoning, to stay away from extremely high P ratio companies, the 60s, the 70s, the 200 P ratio companies. Historically, you'll find, if you use as a rule, investing in lower P companies as opposed to high P companies, those that invest in lower P companies tend to have an overall better performance for their portfolios than those that invest in high P companies. Often people significantly overvalue growth. They don't understand the difficulties involved in achieving the growth rates, and sometimes they don't understand just how long the growth rate needs to occur at certain levels in order to justify very high price levels. But the general takeaway should be you want to be basically in the 10 to 15 level. Above 15, got to be a high growth company. Below 10, look at it for a bit. If it's below 10, there's probably something there that you don't know about. If you investigate and can't find anything else, a company with a P ratio below 10 is probably a very good company to be in. The next thing we're looking at is market capitalization. Market capitalization is basically the size of a company. Now, the one thing I want to point out is that the share price is not correlated with the high market capitalization. For some of you out there, this is going to come as a no-brainer. Of course, the share price doesn't mean that the market capitalization is low or high. But for some novices, this is often a confusion. For instance, you'll talk about a particular company that has a share price of 30 rands versus a company that has a share price of 100 rands. But the share price of 30 rands does not reflect the size of the company. Just like the share price of 100 rands does not reflect the size of the company. Quite often you can find a 30 rand company being significantly larger than a company with a share price of 100 rands. Why is that? Because the number of shares is not equal. If you have 1 billion shares and use 30 rands per share, the company is worth 30 billion. If you have 100 shares and the company's share value is 100, there's only 100,000 rand market capitalization. Now, in our market, the variation is quite large between the very low market cap companies and the very high market cap companies, from a few million to hundreds of billions. Some companies with valuations in hundreds of billions include Naspers, Bulletin, British American Tobacco, SA Breweries, those kind of companies, Sasol. These are very, very large companies. I would advise novice investors to look at much, much larger companies when they start investing. Why is that? For a number of reasons. Firstly, large companies tend to come with larger trade volumes, therefore high liquidity. Larger companies tend to come with more eyes on them. Therefore, if there is something that's fishy in the company, those large number of eyes would probably find that out. By eyes, I mean other analysts, other investors. Sometimes look at small cap companies and people think small cap companies are the way to go because that's the only way you're going to find your millions in the stock market. Be aware, looking at small cap companies, there's always a possibility of very small cap companies, something worth 100 million, could one day be worth 100 billion, and then you have 1,000 times return on your investment. But it's often much riskier to get into a small cap company versus a large cap company. And often there's not as much information for retail investors about small cap companies as opposed to large cap companies. The reason being is that the big hedge funds, etc., they can't really invest in the smaller cap companies. They don't really want to put their brain power or focus their minds on looking at them. They can only make significant or important investments given the size of the companies to large companies, in excess of multiple billions. Therefore, a company that's worth maybe 100 million will not get many high-end analysts looking at it, and therefore you might, when you look at these companies, be unaware of particular things that are important about them and unable to get a really good feel about the valuation of these companies. Okay, and that's basically been my rundown on the share trading page, or the share page on your newspaper. Let's just go to some questions.